Today, we're going to be going over inventory management tips, tricks, do's, and don'ts. Kind of the goal of this session is to really just make you think about your inventory and how it's set up, how you're managing it, what you can do to make it better, and some ways to make your data more accurate. All right. So the fundamentals of an inventory list list structure. So there is some key components that are going to help you keep your inventory accurate and your profits high. So these key components starting out are going, so we have some key components here, and these are the ones that I've identified as kind of some of the more important ones that you would want to pay attention to. So you have your SKUs or stock keeping units. These could also be considered, item numbers, item names. You just want to have essentially something where you're going to identify your inventory items in a unique way. You also want to have product descriptions as a way for people who in the business and people outside the business who maybe might not be as familiar with your numbering system for your items or your naming conventions. You want to have something there for where they can they can know what you're talking about. The other thing is quantity. The next thing is quantity on hand. You want to have you have to have quantity on hand because if you don't know your quantities on hand, you don't you don't know how much inventory you have. Moving down our list here, we have locations. So locations for inventory are going to be where it's located. One of the big things with locations is if you have multiple warehouses, let's say across the country, maybe even across the world, as we are a global economy these days, you might have different tax rates that you have to pay on your inventory depending on where it's held. So having an accurate location locations for your inventory can be really helpful with that, and can make you can really just make you can possibly save you some money. Um, Next, we have preferred suppliers. So as we go through, purchasing materials, purchasing inventory, we're going to come across a lot of different suppliers, right? Some of these suppliers might have great products and higher prices. On the other end, some of these might have really low prices but not that great of a product. So you would need to find that trade-off of who's going to be the best for your business, and sometimes it might not necessarily be the lowest cost supplier, but maintaining that preferred supplier list will help you and everyone in your business know who you want to buy from. Some businesses even go as far as having an approved supplier list where nobody can purchase product from anyone except for somebody who's on that list. Um, lastly, we have things related to cost and pricing. So our costs are going to be how much the material costs, how much it costs us to get it here. This is a pretty important number because it factors into our cost of goods sold, which then can affect what our pricing is. And our pricing is going to be how much it is sold for. So if we do not have good costs, we will not have good pricing. One of those, they kind of play hand in hand together, and they're really important. So as you're looking at this list, though, you might be thinking, there's a lot more data that I want to have. As accountants, we want to have a lot. We want all the data, right? We want everything to be there so we can really know what's going on. But one of the things you have to think of and consider as you're going through and setting up an inventory list or trying to clean up your current inventory list is, I like to say, simplicity, right? The simpler it is, the more accurate your data is. Somebody in your warehouse, they're not really focused on getting all of this information in accurately. They probably aren't going to want to take the time to sit and type in or write down everything else, right? Let's take locations, for example. You might want to know, exactly what spot on the shelf that item is. But whenever somebody goes to pull it, they aren't really going to be paying attention to that. They're going to see the product, take it, and then put it into a box to ship it out. If you have your locations where there's a lot of extra data that needs to be put in there, and it's not being recorded, it's not going to be accurate. And then you're essentially just going to have to keep redoing your inventory list and re-going through everything, and then none of your reporting will be accurate. So the kind of the big takeaway from this slide is just simplicity. You have certain things that you have to have these key components, but and then other than that, the information is really just nice to have, but you have to think, is it essential for you? Is it something that's going to keep you from operating your business if it's not there? And that's just, that's one of those trade-offs that you have to make. So kind of playing off that simplicity thing, organizing our inventory data. So probably my favorite one, and one that I've always preached to my clients, is to use consistent naming conventions. Let's take, for example, one of my clients the other day. They had labels listed, and they spelled labels, or they had label as capitalized one way, lowercase, dashes, spaces. It was about 20 different ways where they just had something marked that it was a label in their system. Whenever you look at that, unless you've been working in that system for years, it's really, really hard to understand. It doesn't really make sense, and it doesn't look visually appealing. Um, and that's something that could slow down your order processing. If somebody's looking at something and they don't know what it's supposed to be, then that's something that can slow down. So using those consistent naming conventions is something that can be really, really helpful and really beneficial for everyone. And again, you'll hear me say it a lot during this, but simplicity, right? Simple naming conventions are going to be a lot more beneficial, right? So we have a simple SKU there, a simple naming convention. It's a lot easier. And then we can go on the back end, and with our reporting, we can add extra things in and maybe make it a little bit more complicated. Um, that's where the hierarchical categorization comes in. Whenever we can go in and add categories to our inventory to really separate it out. Add some extra layers to our reporting. But this isn't necessarily something that needs to be on our main list, because we want to have it as a way to organize our list. We don't want our list to be structured where it's within. We want the names to fit in the categories, not the categories to fit into the names. And the other point on this slide I wanted to cover was just having those unique identifiers. That would be your SKUs, your item names. You really want to just have it where they're uniquely assigned to each thing. All right. So after we go through and we get our list set up, we have our components, we have a nice simple list that everybody from top level employee all the way down to somebody who's just handling receiving packages in the warehouse, they can understand, they can accurately keep it good, because remember, good data is going to give us that accurate reporting. So we do have some inventory management techniques, costing methods. These are this is something that, if you are an established business, you probably already have figured out, but we do have, maybe you're looking to make a change, um, or if you're just starting out, maybe you're a little confused about what the different costing methods are and what their benefits are. So costing methods are vital for any business to monitor inventory and capture of costs related to sales. This is your costing method is going to be how you determine your COGS. So one of the most popular is and one of the most popular and my favorite is average costing. Average costing, it's very simple. You're just taking the total cost of purchased items and dividing it by the number of items in stock. So it's a very easy system to set up, even if you do not have an inventory management software that you're using. Very easy to do those calculations if you're just running your inventory in Excel, for instance. Average cost is used by companies that deal with large volumes of very similar items. Most companies do most companies these days will use average costing. In most inventory management systems, most systems like QuickBooks, for instance, everything is based by default on average costing. So if you're using something like QuickBooks right now, you're not sure what your costing method is. More than likely, you are using average costing and just are not aware of it. So some pros for average cost is that it's very, like I said, simple, easy to apply. Um, the chances of income manipulation are minimized because compared to the other methods, because it's taking that average and you're not having large fluctuations whenever you're taking an average. And then the cost savings associated with it, because it's such an easy costing method to maintain, are very minimal. So again, like I said, most of the time the systems these days are already set up for average costing. But again, if you have to do it on your own, it's very easy just to take and calculate that average cost. Some cons though with average costing, because nothing can be perfect. Cons are that their inventory prices vary and the pricing may not recover. So, for instance, metal material, it changes in price constantly. It might be really high and just not recover. So then it's going to make your inventory cost look a little bit different than it actually is. And then there's also with the average cost, there's the assumption that are all units are identical, and this is almost never the case that everything is exactly identical. For instance, you might buy the same product again from multiple suppliers, same product, but the cost to get there is different. So there's definitely some cons there. All right. The next one that's probably the second most popular is going to be FIFO. So that's going to be first in, first out. So whenever you are using FIFO, you're recording the oldest and you're recording the oldest inventory items to be sold first. So I buy a product, I and then I buy a product, I sell that product. The first product in is the first product out. Hence the name FIFO, first in, first out. Pretty easy acronym to go by there. So some of the main companies that use FIFO are going to be like restaurants, catering companies, things that have perishable stock or short demand cycle. So things where you have this perishable goods, your food might expire. You want to get it in and out really quickly. A couple pros of FIFO are that it generates a higher net income. Often lower older costs are assigned to cost of goods sold, which results in a higher net income. It also matches the natural flow of inventory whenever you use FIFO. So, you want to, with inventory, right, you're wanting to always use you're wanting to constantly turn over that inventory. So this matches that flow. It's also widely used and understood. It is an accepted costing method. So it is something that most people will understand, and it's an easy one to implement as well. Some cons, though, of FIFO are that you may end up with higher income taxes. So because prices generally do tend to increase, means the earliest purchase inventory had the lowest cost and will have a higher margin when you sell it. So you're hence the higher income taxes. And then also revenue and cost don't always match, which can cause you to overstate your profits. Right. Lastly, on here, we have LIFO, so last in, first out. Pretty much almost the opposite of FIFO. Reports the most current prices as being cost of goods sold. So last in, first out. LIFO is mainly going to be used by companies with relatively large inventories, such as retailers, people in the automotive industry. Those are kind of the two main examples. Some pros of LIFO are that during inflation, cost of goods sold is higher, reducing profit margin, which results in a smaller tax liability. And it's most appropriate for matching costs and revenue. Cons of LIFO, and one of the biggest cons of LIFO is that it's only used in the US and it's banned or restricted by certain organizations. So if you are an international company, you using LIFO is going to be it's going to not be an option for you, but it is an option if you are US based. Another con is that LIFO has the highest amount of COGS, and your profit margin and income is lower. It's also not really a good indicator of ending inventory value, because inventory value may be understated. All right. So our next thing to go over here is inventory tracking and control. So with inventory tracking control, again, we'll go back to our topic of simplicity, right? We want to make things we want to make the data that's feeding into here simple and easy to maintain. And this is where we're going to start to maintain our inventory better, start to really understand and really take a deep dive into it. In order for our cycle counts, safety stock, or reorder points to be effective numbers, we need to have good data. If you it, like whenever I used to work in industry, there'd be a lot of times where I look at our inventory list and just go, I don't know if this is accurate. I don't know if this is good. You never want to be in that situation where you're doing that. You always want to be able to look at at your at your inventory list and your inventory counts and go, okay, yeah, there might be a little bit of variation, but I'm pretty confident in these numbers and they know what's there. You never want to have that situation where your sales team is selling a product because it's showing that you have it in inventory and then it's not there and there's a 12, 15 week lead time on that part. So keeping that list simple to have your accurate data is going to help you. And then once we get in here, there's some things that we can do to really help maintain that list and help our inventory really work well. So one of the first ones, and probably one of the most common, and also one of the most easy to implement, is going to be cycle counting. So cycle counting is really just a method of inventory tracking that is where you take a small portion of your inventory and count it, whether that be, maybe a certain like section of your warehouse, maybe a certain product. You're just counting that to make sure that it's accurate, make sure that your numbers are there. It's a lot easier to maintain and do than a full physical count. Um, as if anybody's ever gone through a physical count, it's a very intense process. Everything has to Everything essentially has to come to a stop. You can't really keep doing sales. You can't really have anything go on because you have to count that inventory. In this day and age, with everything, with e-commerce and online orders, and everybody wanting everything almost immediately, having those down days is basically not an option anymore. So that's where cycle counts come in. And whenever you're doing cycle counts, you have that small portion of it. So whenever you do your cycle counts, you see that it's good. It helps your physical inventory. It makes it whenever you go to physical inventory, you can know kind of where everything is. You know what your last cycle count numbers were on that, so it can really help. Cycle counting also helps companies to maintain accurate stock records and monitor product levels. It also reduces the likelihood of shortages. The example I mentioned, where you might have something show up in inventory that's not actually there. We don't want that to happen, and cycle counting can definitely help with that. Also, just to reiterate, it's a lot faster and less disruptive than a full physical inventory count. Again, this does not replace a full physical inventory, but it makes it where that physical inventory can be done a lot faster. If you're not doing physical inventories, they should be done at least annually at the minimum. Quarterly is awesome and makes everybody every accountant that you're going to possibly work with a lot happier because they know that the numbers are being checked a lot more often. But at minimum, they should be done annually. So moving down here, we also have safety stock. So going back to our big lead time example, um, safety stock can play into that as well. It's determining how much stock you want to keep on hand. You never want to have a situation where you have a stock out coming in. So a stock out is where you are selling product, but you do not have it there anymore. Um, we saw this happen a lot during COVID with the aftermath with the supply chain issues. So stockouts are definitely becoming definitely lot bigger topic these days than it might have been in the past. Our So we want to maintain a safety stock. There's a lot of different systems and ways that can do this these days. It is very complicated. This is actually one of the big areas where AI is playing into inventory a lot by determining safety stock. Safety stock you can get yourself into a lot of you have spend a lot of money on determining safety stock. Um, just kind of to summarize it down, um, it's just safety stock, just the extra inventory that a company keeps to reduce the risk of running out of stock. The purpose is just to protect against demand spikes, supply chain disruptions, other uncertainties that cause those stockouts. So you never it's think of your safety stock as like your backup, right? You want to back up your systems, back up your hard drives. You want to have a safety stock or a backup for your inventory. So if something happens, you still have something to sell, and you have enough to maintain while you're getting new material in. You never want to especially you never want to run out of a product. Safety stock, it does again prevents those stockouts, um, and then it also helps make sure that your company can proceed with business operations as planned, maintain continuous production, provide higher customer service levels. No customer likes to hear that the product is not in stock. I know myself. I know I like to do my fair share of online shopping, and if I see something's got a really long lead time, I'm going to go to another place that has that same product. So that because they have it in stock. So having those having the stock level, having that safety stock can really help out with your sales if that's something that you're experiencing where you're experiencing a lot of stockouts. And again, as I mentioned, calculating safety stock is very, very, very complex. There's a lot of different formulas that can go into how it's done. Um, one of the one formula, as an example, is is the reorder. Uh, sorry. Yeah. So there's a couple really complex formulas that you can utilize for that reorder. All right. So lastly on here is our reorder point. So reorder point kind of plays into safety stock. We want to have for our whatever once we determine our safety stock, that's going to help us determine our reorder point. Um, there's you can use formulas to determine this. You can also have a stagnant number where you say, here every time I get to this certain point, I want my system to automatically trigger a reorder. This could be, whenever you get, like to use real world examples, working with a client now where they want to, whenever they're using cables on big spools of cables for electrical systems, what they want to, whenever they get down to one spool, they want to have a reorder. They want to know that they need to reorder more. So that's kind of just a nice a nice stagnant number. It's not really not as much based off of that, but based off of a formula. The reorder point is the level of inventory at which a business should place a new order to avoid running out of stock. It's also your reorder can also be called the reorder level. Businesses will use the reorder point to meet customer demand. You want to ensure that customers receive their orders on time and have a positive brand experience. Um, Again, plays into that safety stock idea. Optimizing inventory. So reorder point will avoid stockouts, overstocks. Um, an overstock is the opposite of a stockout. Overstock is where you're buying too much inventory and you're not able to move it. You're not able to sell it. You might have inaccurately forecasted demand. One product might have been selling really well during the holidays, but nobody wanted it anymore after that. So you're just left with a lot of that. That's something that you want to avoid as well. Overstocks and stockouts lead to higher costs, lost sales, and damage to your brand image. We also want to keep our costs low. So reorder points will help us to avoid storing more inventory. They can be sold in a timely manner. Um, that's a waste of capital. It also can factor into your inventory holding costs, and then could also factor into your tax liability if you're having to pay tax on your inventory on hand. So calculating your reorder point, you really just need to know the lead time, so how long it takes your vendor to fulfill the order and get it to you, and then the safety stock, the amount of extra stock to avoid your stockouts. Again, safety a reorder point, just like safety stock, it can be you can get your formulas can get very complicated. Trying to figure out what's the best. You Again, as I mentioned, idea is to keep things simple. If you have to weigh your pros and cons. It's doing a having a really complicated formula that has a lot of inputs into it. Is that going to be helpful in the long run? For some businesses, yes, it will. For others, having that stagnant reorder point will be more than sufficient for them. At the end of the day, you have to remember, there's great formulas, great things to help you out, but you know your business, and that's what and so at the end of the day, it's your choice. But just going back over cycle count, safety stock, reorder points. These are all things that can really help you with your inventory, help you really understand what's going on, and help you prevent those stockouts and overstocks, which can help you maintain a great brand image. Okay, so going to, moving on, we want to be able to use technology to our advantage. So these days, where there's um, there's a lot of great inventory systems out there that can do a lot of this work for you. So you might have, as we're going through this, you might think, figuring out, SKUs, figuring out, how to keeping accurate costing, doing cycle counts, doing setting reorder points and maintaining them. It's all a lot of stuff to try and take and handle on your own. But there's a lot of inventory management softwares there that can help out with this. A couple that we work with here at Certum that I am big fans of. Obviously, we work with QuickBooks Enterprise, their advanced inventory functions. It does a really good job for your base level inventories. But you can go a lot farther than that. We work with a company called Sen7. They do a lot of great work with inventory. Everything gets put online, and everything is really accurate. A lot of these things here, it takes where you have to do minimal data input to get everything that we've talked about calculated for you today. You want to You want to utilize that. You want to utilize technology to your advantage. It's going to help you with your inventory list and help you be more accurate. Um, at this day and age, if you are even if you're just maintaining an inventory list in Excel, you're probably going to be behind the game whenever it comes to your competitors, because that's something that you have to constantly maintain and constantly update. It's not doing it for you. You want you want to use that technology to do the work for you if possible. Um, and one of the things whenever it comes to technology that you might have heard a lot about that you might be looking to implement is barcoding. So barcoding is a pretty simple thing to implement, and barcoding allows for you to have a lot better data. So instead of somebody having to go and type in and point out what they're doing, they can scan that barcode. And implementing and setting up barcodes is really simple. Um, I'll give everybody a little kind of back end barcoding tip. A barcode is just a no, is just a number with a that's put into a different font. So it's not really complicated to set up your barcodes. And most of the time these days, you can use your phone, a tablet. You can even get handheld barcode scanners pretty inexpensively, and that can scan those numbers. So it's one of those very low lift items to set up and to maintain, and it can lead to much more accurate data and accurate information. So again, playing onto our kind of theme, our subtle theme here of simplicity, we can um, we can do that with that. And I do see a question that come through, and I'll go ahead and just while we're talking about barcoding, address it now because that was kind of going to be my next one. So for smaller items, what you can do for barcoding is instead of putting it on the actual product, you can put it on the shelf. Maybe you have a bin where that product is. You can put a barcode on the bin, and then whenever get pieces out of there, you scan that bin, and it takes those pieces out. There also is some more advanced technologies like RFID tags that you can put on things, but it's it you don't need to think don't think that every single individual piece has to be labeled with a barcode, because you don't want to you don't want to implement something that's going to take a lot of time and not be easy to maintain. So usually with barcoding, you're going to see it mainly on those larger items that come in, or we'll put it on like a shelf or a bin. I've even seen some places where they've had big engines, and the barcode's just been on the front of the shelf where this engine is sat. It's not actually on the engine. The barcode is really just saying, it's saying right here, if it's on the shelf at this spot, this is what it should be. So hopefully hopefully that can help with that question. All right. So kind of the last thing that I wanted to go over and cover with this is going to be some KPIs, some key performance indicators for inventory management. These are some things that you maybe might want to look at, might want to maintain. But as far as we have our we again we have to have good KPIs. It all starts at the beginning with that simplicity. We want to have good data. We want to make it easy for our team to maintain good and accurate data. So the first KPI, and probably one of the more common ones, and all these are pretty common, is going to be your inventory turnover ratio. So your inventory turnover is the rate that your inventory stock is sold or used or replaced. The turnover ratio is simply calculated by dividing the cost of goods by average inventory for the same period. A higher ratio will tends to indicate stronger sales, and a lower one is going to indicate weak sales. That turnover ratio, if you've ever looked at an inventory turnover report, it's just going to give you that number that says, here, this is how often we're turning over the inventory. This is how often we're having to buy it, it's being sold. That it gives you an idea of of if the company has stagnant inventory that's just sitting around, if they're healthy and making sales. And again, with any ratio, you want to you don't want to you want to have it be a good period. So if you're a type of company where you're buying all of your inventory and everything in the off season, so then you don't have to you have a stock to use throughout your busy time. You know, whenever it's your off season, if you look at your inventory turnover, it's not going to look great. So you want to have a good time frame that plays into that. Our days of inventory on hand. So the days of inventory on hand is going to measure how many days a business takes to sell its inventory stock. So really just like you're really just going to let you know how much stock you have on hand, how many days you can go with the current inventory that you have there, as the name applies. Financial analysts will use investors use it to determine how efficient a business manages its cost. It's also important for a number of reasons, including customer demands, a low days of inventory on hand, or another way you might have heard this is DOH, days on hand. It allows retailer so low DOH allows retailers to quickly respond to customer demands and bring out new products. Um, it also impacts cash flow, liquidity, and operational efficiency. And then lastly, inventory it's going to be probably going to be your biggest investment. So anytime you can reduce the days of inventory on hand and still have a good safety stock, and you're bringing those stock outs and those overstocks, you can improve cash flow and decrease the time to revenue. The next one is our stock to sales ratio. So our stock to sales ratio is just going to be average stock value divided by net sales value. It also is known as the sales ratio, or the IIS ratio. It measures the amount of inventory a company has compared to its sales. A lower ratio is generally better, as it tends to indicate that a company is selling through its inventory quickly. Higher ratio could mean that a company has too much stock compared to sales, which could point to some business issues. All right. And then lastly, we have our inventory carrying cost. So our inventory carrying cost is going to be how much does it cost us to hold and maintain that inventory? Do we have so much inventory that we're having to rent out another warehouse to keep it in? Is all the cost that it keeps us there? Are we having to move around our inventory and sell it? Are we having to bring that inventory from another warehouse into our area? Is our inventory even in the right location and right place for where the sales are happening? So that carrying cost is going to be how much it costs to carry the inventory. Just wanted to highlight some of the key services that Certum offers here and ways that we can help you with your not only your inventory but your accounting. So we do offer accounting, bookkeeping services, e-commerce solutions, inventory management, and process automation. That is one that I always like to point out and highlight, especially if you are having any problems with your inventory. We are always happy to take a look at it. Give you a couple ideas, work through with what's the best way to maintain it. We've seen every single possible scenario for great inventory systems, for bad inventory systems. So we can tell you what's working or what's not. There's a lot of times where you might think that your system isn't set up well, but it really is. So we can be here for you guys to go through, really look at your inventory and help you out. We also can provide training for your staff on how to accurately use and maintain the inventory, and we can go through and explain to them what everything means so they can pay attention to it. And again, um, reducing those errors, keeping it simple with everything. We also can help with software migration and implementations. As I mentioned, there's a lot of different inventory management softwares that are out there. We can help you identify which one will work the best for you, what we and then migrating from from a current system into the new one, or maybe even just adding in the new features. Maybe you're already on something like QuickBooks Enterprise and you want to add in advanced inventory. We can help you migrate to add those features on and go through and setting this up in training. We can provide remote training, um, on-site training as well. We really just want to make sure that we're helping everybody out here and finding the best thing. And then lastly, we have custom one-on-one advisory services, so you can come and meet with us, be with me, another person on the team, whenever you have any questions and you want any advice or any help. All right. Lastly, just our contact information, um, phone numbers, website, emails. You can write that down. We are based out of our headquarters is based out of Monroe, North Carolina, but we are we have a lot of people working remote all over the country. So chances are that we have somebody close to you that can come and help you out if you are needing that extra help and want to meet face to face. All right. Um, if there are no more questions or anything at this time, I want to thank everybody for coming to this webinar. Hopefully, you are able to gain some good knowledge.
Alrighty. Well, thank you everyone for joining today. And if you need anything, reach out. Have a great day.